If Bitcoin or crypto assets in general were truly a legitimate off-ramp and salvation from US dollar hegemony and all of this stuff, why isn't Bitcoin at least at 35,000 a coin right now? It's barely above 28,000. It really hasn't moved that much. And I think the real answer is that most people in Bitcoin are not trying to hedge their existing fiat currency exposure. They're just picking off people in retail. And they're just day trading this thing. How else do you explain an asset that is not absolutely ripped in the face of all of this terrible news about the financial system? And I think the answer is because it's still a cul-de-sac of users. It's not broadly available, not broadly adoptable, not broadly used. I still believe that it's valuable. I was the earliest proponent of Bitcoin, 2011.
Yeah.
2012. So I believe that there's a place for it in one's portfolio, but I just think connecting these dots misses the point. And I think the point is much, much bigger than a crypto off-ramp. The point is that we have a lot of systemic shocks that are building up in the system. We have broken a ton of the systems that cause the financial infrastructure in the world to work properly. And we are just starting to uncover how they're broken. So I think we need to focus our energy on that and dial down a little bit of the Bitcoin maxi stuff because it distracts from a really important set of topics that are more inclusive and actually touch 7 billion people. But the reason that we print so much money is sort of what Freeberg says, which is that we just want a well-functioning society. And the simplest and shortest way to do that is to make sure that there aren't any winners and losers anymore. And the most effective way to do that in the markets is with money. Print a bunch of money and there are no more winners and losers. And so everybody can kind of win. Some people may win more, but nobody really ever loses. So I think that's the MO that we're operating under. But the other part of it is like, does it reinforce or does it decay US dollar hegemony? And I think it actually reinforces it. And the reason is just very practically speaking, when you look at how dependent other people, other countries are on the US dollar, in times of stress, they actually become more dependent. And that has a lot to do with their borrowing patterns, the amount of dollars central banks need outside the United States. And so what did you see in a moment of stress? Actually, the Fed opened up swap lines to all the central banks that they work with, their most important operating partners, so Europe, Canada, Japan, etc., Switzerland. And they moved the liquidity window from weekly to daily, and they pounded the swap lines. So I don't know. I think that most people that kind of like, it's like a boy crying wolf. Maybe at some point somebody will be right, but you're going to lose so much money trying to take a point of view around this topic that it's more practical to just look at dollar flows. And dollar flows go up in moments of stress, not go down. And they go up in a distributed manner across the monetary plumbing of the world. FTX was days away from getting a critical approval by the SEC to actually even further legitimize their US exchange before they went out of business. So I think Gensler had to pivot very hard from, at a minimum, being very pro FTX, and there's all kinds of stories about his interrelatedness with Sam and his family, to very anti-bit or anti-crypto in general. That's clearly happened. But look, I think that this is like a lot of tin hatting, which I don't think is very productive. If you look at the total number of non-zero Bitcoin wallet addresses in the world, and let's be extremely generous and say it's 100 million, there's still 7 billion people in the world. And so I just think everybody that tries to speak about the fragility of the US and worldwide banking system is right. And that part I think is quite lucid and unemotional. But every time they try to connect it to Bitcoin, they sound like a crazy person because they're just talking their book. They took the worst option, which is neither did they cut, nor did they raise enough. And so this problem that Sachs represents actually is the fundamental problem now, which is you won't have enough clarity and signal to really know whether this 25 basis point enough. Look, I've maintained now for 9 months that rates are going to be higher than we like and longer than we want. And so I think it's high time that we acknowledge that we have a sticky inflation problem whose back we have to break. We've known since Volcker era what we need to do that, which is you need to get interest rates to be greater than terminal inflation, which means that a 5% Fed funds rate is insufficient. So we're going to need to see a print of 5.5, 5.75%. And that's when you're going to have enough contraction. And then the Fed can come back with liquidity. But if they don't take these steps, we're going to be in this very choppy, neither here, neither there situation. And I think that is what causes the real damage, because it's the corrosive effects of uncertainty and what that does to lending, to risk taking. And that I think is really bad for the economy. I didn't think TikTok did a very good job. And I think that there are some...
They were terrible today. Terrible.
And I think that there are some real issues around how much control does actually flow back. I don't think that it was definitive. He needed to be much clearer and adamant that this was an independent business that didn't have backdoors to China and the CCP to appease Congress. He didn't do that. That first question was just a death blow right from the beginning. It's like, this is not going to go in a good place, because they should have been able to see that that question was going to get asked. And you need to have that asked and answered philosophy where the only answer is no. The only answer you could have given is no. And the fact that he wasn't able to say that, it was a bit of a fait accompli. As soon as that was in my mind, I was like, this thing is getting shut down. Because I don't think there's
shut down. Wow.
Yeah, there's no divestiture plan that can be technically audited in a short amount of time to appease these folks. They want a pound of flesh. And then separately, the bigger issue that I think you have to deal with is, what does that mean for how other governments may be pressured to act who want to be on the pro-US camp? And I think that that's a question, because ByteDance and TikTok have presence beyond just China and the US. A third question is, how does the golden vote get used on the ByteDance board? And what do they do? And do they even want this thing public?
Explain golden vote.
Essentially, they'll decide what happens to that company. And they have that in Alibaba. They have that, I think, at Tencent. I think they have that at ByteDance. So the Chinese government has a very strong hand in the direction of these businesses. And then the final point is that there's a secondary app that TikTok has called CapCut, which also is enormously popular in the United States, which is yet another potential backdoor for privacy or spying violations, whatever the US Congress wants to pin on them. So I think it's a very complicated moment for that business and their US asset. Government be satisfied that the code base was separated elegantly, that there was no malware surreptitiously planted. How will you actually prove all of this to a degree that satisfies a legislator? So I think the pound of flesh that they want is more easily and more salaciously satisfied by shutting the thing down. So if I had to bet on what happens, I bet more on that. I see it in the credit default spreads of these banks. It's in the water table already. So Nick, you can just throw it up. If you look at any bank that's lending and that has a portfolio, this is Deutsche Bank's, euro-denominated CDS. But it's the same for Barclays, it's the same for SocGen, it's the same for a bunch of American banks. There is a risk in the system that Sachs articulated that is now getting priced in. There are all kinds of loans whose payments, which the banks need, cannot necessarily be insured, which means that then there could be illiquidity there. There could be a flow of deposits out from those banks, which would then make their ability to pay their debt holders lower. You also have this complicated issue already where it's really like the first time in a long time where debt holders actually got wiped out in the Credit Suisse debacle before the equity holders did. And that's created all kinds of ripple effects. So this credit bubble is here, and it's being manifested right now in these very sophisticated parts of the market. And eventually they'll ripple to the broader economy at large. But how a person feels this is they're not going to be able to get a car loan or a mortgage, or the interest rates they pay will go up. And then how bondholders will react to all of this stuff is they'll just start to find different assets, probably the front end of the curve, money market, cash, gold, and they'll just abandon all these assets. And then the other problem is that it's just really, really bad for risk assets. So the things that we invest in,
startups, technology companies,
either in a world of inflation run amok because the Fed isn't hiking fast enough, which just destroys future cash flows, or in a world where the Fed pivots in a moment like this, and Nick, you can show the second chart, both result in the same outcome, which is that you just see these massive drawdowns in the value of risk assets. So we're in a really complicated moment. And this is why I think, again, the Fed needed to take leadership this past week and actually do the hard work of either cutting 50 bips or raising 50 bips. And this middle path is the absolute worst path because trying to thread a needle in this complicated economy, I think, is just going to be impossible. And then what happens is then the markets move around them, right? The markets have completely said, we now discredit what you did. And they're basically banking that the Fed will be forced to cut rates massively in short course because the crisis will be so severe that it'll outweigh the risk of inflation. In early May, the Fed will release their investigation into Signature Bank and SVB.
Okay.
Powell said that this week. I think it'll be really interesting to see how much honesty they both put into the report and then whether the entirety of that report is made available to the rest of us to read. But I think Sachs has very elegantly summarized what's happening. And it doesn't take a genius to figure out that this doesn't make sense. And so the question is, what is the tolerance that we have for changing something that clearly is mischaracterized? What consumers think they're getting and what banks are then doing are two totally different things. And if the Fed actually is really, really honest and really lays bare everything that happened, it'll be very hard to not legislate changes based on it.
And your best swing at a legislative change would be what, Chamath? What is the low-hanging fruit? What's the layup here?
Well, I think we've seen this happening in other markets for a while, which is that banks have become, in fairness to them, much, much better at risk management post-Dodd-Frank, post-Great Financial Crisis. And the result of that is that there's been a lot of emerging private credit markets because most of bank is about lending, right? They're not really buying equities, they're lending money. They're a debtor in possession of something, right? And there's been just a massive explosion of private credit. And it started in the most obvious areas. It started in things like CLOs. It started in asset-backed securities, solar, car loans, credit cards, mortgages, private equity-backed deals. So I think the rational answer is that banks need to protect 100% of deposits, and that if they want to have extracurricular activities, if you will, they need to be able to raise money from investors, put that to work in a really fair and transparent way, and then share in the profits between all of the related parties that are involved in that transaction, no different than any other risk-taking organization. And I think that this is now what we've probably shined a light on is a really odd loophole that just needs to get closed in 2023.
There's such easy hygienic changes here.
Let's put it a different way. Yeah. If you raised money for a liquid hedge fund that had quarterly redemptions and then violated the LPA and stuffed it into private companies that had 10-year illiquidity, there would be hell to pay.
Yeah.
And vice versa. If you raised money on 10-year illiquid locked up capital on the presumption you were going to invest in startups and then instead put it in the stock market thinking that you could flip it and make some money, you would have violated the LPA and there'd be hell to pay. Similarly, I think what Sachs is stating is that there is a mismatch of what the depositor, in this case, the investor, expects and what the risk manager is doing. And I think that you have to correct that one way or the other. Make it abundantly clear that we're never going to insure 100% and deal with that risk. Or make it 100% and deal with the fallout, which is largely about wiping out a lot of equity value in banks.
LPA equals limited partnership agreement.
Right. And just to clarify one thing, I'm not saying that these bank managers are all going to the casino and gambling the money. I think that they are generally more responsible than that. What I'm saying is that the incentives created by this crazy system we call banking create a weird incentive for them to gamble because they're so highly levered. From their standpoint, your deposits are their leverage.
Everybody but the GSIBs, because I think the GSIBs, there's so much scrutiny. If you look at how well run Citi, B of A, Wells and JPM are relative and contrast them to the sub GSIBs, it's like night and day. And so the other thing that I think we've realized is who thought it was a good idea to raise the bar on eligibility from 50 billion of assets to 200? Clearly now that made no sense. It makes more sense to actually categorize every bank as systemically important, maybe not globally, but at a minimum to the US economy, because these people play a vital function in society and they were allowed to take a much more aggressive risk posture because they were able to lobby the government to change the rules.